Back to within 1% of all-time highs, despite the jobs data coming in thick and fast, mixed results. 30 minutes until the start of trading. I'm Dani Berger. Matt Miller is off. Bloomberg Open Interest starts right now. Coming up, AI anxiety, a tepid outlook from Salesforce fails to impress, heightening the stakes for results from chipmaker Broadcom. And it just might be the hottest ticket in town. Tech leaders, including Zuckerberg, Cook, and Nadella, all set to attend a White House event tonight. Meanwhile, Fed Governor nominee Stephen Miran heads to Capitol Hill as President Trump's threat to the central bank starts to worry investors. Some stocks on the move this morning. Salesforce falling. Investors seeking stronger sales growth from its AI pivot. Again, those tech leaders going to be at the White House today. Figma, also another set of results, down 15.4%. It failed to meet a high bar for its first earnings report. And today, Broadcom's $730 billion rally will be tested with earnings after the bell. But first, we start with Wall Street and a story breaking moments ago. Citigroup is entrusting its wealth business about $80 billion or so worth of assets to BlackRock in a new partnership. Bloomberg's Todd Gillespie reported on the news, broke that story just moments ago, and joins us now. Todd, great to see you. Excellent reporting. What exactly does this partnership look like?
Well, essentially, Dani, this is the last asset manager at Citigroup. The last asset management operations in the entire bank is finally being shuttered, and $80 billion of AUM is being handed to BlackRock. That's a large chunk. That's about an eighth of all of Citigroup's wealth client investment assets. So we're looking now at an environment where banks are increasingly looking to partner with asset managers, looking for other options, looking to do this more efficiently. It's a big part of Jane Fraser's goal at Citigroup to improve returns, streamline its wealth business, increase revenue, and essentially deliver more outsourced products to its clients.
But how much of this is Citi almost backing away from some of the wealth management division in that they're entrusting BlackRock with it? When we've seen other, let's say, basically all of global Wall Street try to double down on their wealth offering.
No. I mean, it's essentially Citi saying we're going to stick to our knitting in terms of they are going to double down on the advisory side of things. They're trying to hire more advisors. They're trying to expand their products to the mass affluent. They're trying to grow their wealth business, certainly, but do it in a way that they know they can do the thing that they're good at, BlackRock can do the thing that it's good at, and everyone can partner up. Notably, Citi, unlike Goldman Sachs, unlike JP Morgan, unlike Morgan Stanley, Citi doesn't have an in-house asset management platform that it can, share products between. It can get, it can kind of has its own built-in partnership. And now it's looking to BlackRock to essentially provide that service in a similar way that Citi in its banking business has looked to Apollo to provide private credit.
Well, to that point, it's kind of the moment of partnerships. Another one that you reported on this morning was T. Rowe Price and Goldman Sachs taking a large stake in them. What is the aim of Goldman in doing this?
Yeah, it's a good question, Dani. And I mean, for a lot of people, T. Rowe Price is seen as a fairly ailing asset manager, right? I mean, hundreds of billions of dollars of outflow we've seen since the peaks of 2021 when T. Rowe Price's shares were up high. I mean, now we're looking at Goldman Sachs appearing to see some undervalued opportunity here in T. Rowe Price, particularly in its position as a leading retirement manager, manager of retirement funds in the United States. Bear in mind, we've seen Donald Trump's administration grease the wheels just recently for banks to start to put more private credit assets, more alts platform products into individual investors, 401ks, retirement plans, and Goldman is looking for more channels to collaborate in order to do that, to make sure that it can get its products into the hands of T. Rowe Price customers as well.
Todd, excellent reporting. Thank you again for bringing those stories to us. That is Bloomberg's Todd Gillespie. Let's turn to tech now, and where we had earnings. Salesforce after the bell yesterday projecting weak sales growth compared to Wall Street expectations. That's adding to anxiety around AI's return on investment. Let's bring in Mandeep Singh, Global Head of Tech Research for Bloomberg Intelligence. And Mandeep, I think there had been some real hope that Salesforce investment into AI was providing returns, that people would actually be using their AI agents. So is it not happening? Is it delayed? What's going on?
I mean, look, when you compare Salesforce to a Microsoft, which is, 5 times bigger and growing double digits, the high single digit growth just doesn't look good enough. And so from that perspective, they called out, adding AI products is just not making a difference. And everyone is comparing the AI revenue contribution. In the case of Microsoft, it's close to 15 billion. For Salesforce, it's less than $1 billion. And so the main question here is, do the AI products get consumed through someone like Salesforce, or are companies building it themselves? Which is why all the database companies did so well this quarter. We saw Palantir, MongoDB, Snowflake. I mean, companies are using their data and building their own AI agents. So the question is, do they build AI agents through Salesforce, or do they build it themselves? And that's what's reflected in the growth right now.
It's a good question, and a lot of questions surrounding tech. And we're going to get maybe more question marks with an event at the Rose Garden. I think the spokesperson for the White House called it like the hottest club is the Rose Garden Club. Yeah. So we're going to have Zuckerberg, Cook, Satya Nadella, among others, at an event hosted by Melania Trump. Do we know what this event is? Do we know what the impact of it might be?
I mean, look, the president had an executive order where they specifically mentioned AI infrastructure as a big priority and, you know, exporting the U.S. large language models to other countries. So from that perspective, I mean, these companies really are pioneering the build out of that AI infrastructure. In fact, NVIDIA said the hyperscalers will spend almost $600 billion in aggregate next year. So think of all the companies that are attending the dinner. That's where the $600 billion is coming from. So from that perspective, I think they would want to know the timeline and the ramp up of that AI data center.
It also just comes in such an interesting time for the regulatory landscape for these tech giants. We talked ad nauseum perhaps about the Google ruling yesterday. But what does it say at this moment where the AI is developing quicker than regulators can keep up? How much of this will be weighing on administration's mind that many people hoped would be more lax when it came to regulation?
Especially when it comes to the biases of the model. I think one of the concerns that was raised during election time was just, you know, whether the social media is left-leaning or right-leaning. And so with the models, it's the same thing all over again. I mean, these models are trained on data, and you want to make sure that, you know, they are as neutral as possible, and just how the models are trained and what are their biases, and those sort of questions are still very relevant.
Yeah, a very good point, Mandeep. Thank you so much for joining. Yeah. Thank you for that. That is Mandeep Singh of Bloomberg Intelligence. Also, Figma reporting its first earnings report after the bell yesterday, moving on that, where the company's sales outlook failed to meet Wall Street's lofty expectations. The stock is up more than 100% since going public in July and is down 16.5% in the pre-market. Bloomberg's Bailey Lipschultz joins me now. Bailey, we were talking about yesterday about what a big test this was for Figma. So did it fail that test?
It failed the test, Dani. I think in Spider-Man they said with high stock prices come high expectations, maybe something like that.
Yes.
But really, when you see a stock that rallies like this, you have to beat expectations. That's what we spoke about yesterday morning. You have to beat and raise. We saw revenue relatively in line with what Wall Street was looking for, and this is Wall Street that modestly is kind of, or for the most part, is kind of a hold equivalent on the stock. So when you don't beat those expectations, you have profitability falling short. That's why you're seeing the stock down so sharply this morning. Again, we've seen a lot of these momentum IPOs pulling back from their recent highs. So Figma really the latest, but again, you can't miss your first print after going public.
So you go public, you miss your first print. Bailey, we also talked about this idea that maybe a test for the general IPO market. Does it give people pause that, sure, you can get a 250% rally in your IPO, but you just steadily eat into that gain, especially if you can't show up with your earnings?
There's a lot of kind of debate around the current IPO environment. When you look at how these deals are being priced, when you look at how they're trading on day one, I think many bankers and investors would say 250% is not really what they want to see. It's a lot of momentum. There is a retail trader aspect at play with that kind of dynamic. The goal and kind of what we're going to see next week with a number of these deals pricing and debuting is, are we going to see banks push on price? Are we going to see kind of more modest opens? Are we going to see stocks that are up 20, 30, 40% and not 100 or 200%? Because most people would agree that's not really good for anyone.
Yeah, I mean, unless you're a shareholder who bought at the IPO and you're
sold.
Still up.
You had to sell.
And sold, or you're still up 100%. So that's not too bad. Bailey, thank you so much for joining. Bloomberg's Bailey Lipschultz. All right, a quick check on futures. We're about 20 minutes away from the open, and we continue to gain. Some of those gains starting to peter out. A lot of mixed jobs data coming in. How do you handle that? How do you incorporate it? We still are within 1% away from all-time highs, even though we are little changed in this morning's pre-market session. And coming up, we're going to talk about this morning's data on a labor market, some of it pointing to cooling, some of it pointing to steady jobless claims. We're going to break it down and what it means for the Fed next. You're watching Bloomberg Open Interest. Let's get you some high interest stories. A look at what's making headlines around the world. Apple planning to launch its own AI-powered web search tool next year. Sources tell us here at Bloomberg that the system will be integrated into Siri and eventually its Safari web browser. The underlying tech enabling it could come in part from Google. Apple is aiming to release the service in the spring as part of a long-delayed Siri overhaul. Elsewhere, HPE delivered better than expected sales and profit in the third quarter. The CEO said the company expects to weather narrowing profit margins as it enters a new era of AI-driven demand. And don't miss our conversation with HPE CEO on Bloomberg Tech. That will be at 11:40 a.m. Eastern. Shares of American Eagle surging just under 28% in the pre-market. It reported higher than expected quarterly sales and probably you can guess why. The success of its controversial ad campaign featuring actress Sweeney. They said they sold out literally of all of the jeans that she promoted. So thank you, Sweeney. Now on the data front, initial jobless claims rise to their highest level since June. And even though it was steady, it did signal that the U.S. labor market might be cooling alongside an ADP report, which was also worse than expected. Bloomberg's Michael McKee, international economics and policy correspondent, joins us. Mike, a lot of jobs data coming in over the past 48 hours. What do you make of it?
Well, it's basically telling the same story, the same narrative, Dani, that the Fed has been looking at and that people on Wall Street have been talking about for a while, that companies are not hiring, but they're not firing too many either. 237 still a very low number in terms of jobless claims, but only 54,000 jobs created in the private sector, according to ADP last month. We'll see how that plays out when we get the non-farm payrolls number from the government tomorrow. Continuing claims fall, 1,940,000. That's 4,000 lower than they were the previous month. So it doesn't suggest a labor market in free fall. Might also note the trade balance widened, kind of expected, but it did show a big pull forward of imports during the month of July, and it suggests that people were, again, trying to get ahead of tariffs.
Then you also get that Challenger's job report, which has the weakest hiring plans for August on record. Mike, how does this set us up for tomorrow's non-farm payrolls?
Well, basically, we're looking at not much gain, 75,000. That is not a real firm estimate, I think, from people on Wall Street. They're willing to concede that we could go either way. We could see a strong report. We could see a weak report. And a lot of that may have to do with seasonal factors. But it's definitely a situation where people are expecting some weakness as the economy slows down. We also, of course, Dani, want to look at the revisions and see what we get after that 258,000 revision last month.
We will be looking at it, and the White House will be looking at it, Mike. Speaking of the White House, you're down in Washington, D.C., and Stephen Miran, in about 45 minutes' time, is going to be starting his confirmation hearing to see if the White House, which they want to do, can get him on the FOMC before this month's decision. What does the timeline and road ahead look like that for it to happen, Mike?
Well, it looks like it could happen because Republicans basically in the Senate will do whatever Donald Trump wants. It's not easy to do the way their calendar works, but it certainly could happen. Now, Miran is going to be questioned today by Democrats in particular over his stance on Fed independence. In his opening remarks, Miran pledges to use his economic background to make decisions, not his political background, saying the most important job of the central bank is to prevent depressions and hyperinflations. Independence of monetary policy is a critical element for its success. My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship. However, Miran did write a paper last year before he joined the CEA, which called for nationalizing the regional Fed banks and letting governors appoint the boards of directors who would then choose the bank presidents, which would inject politics into the Fed. He also says the president should be able to fire any Fed official at will, also political, and he looks for a major turnover of the Fed staff because the president can do that. So there'll be a lot of sharp questions about whether he's going to be too political for the job, but the Republicans have already indicated that he's not.
Mike, really looking forward to your coverage of that hearing. Again, kicks off in about 45 minutes' time. Bloomberg's Michael McKee in Washington. And again, he'll be there the next hour from Capitol Hill. Stephen Miran will be testifying before the Senate Banking Committee. All right, let's check on futures. Just 10 minutes away from the opening bell. We are within 1% of all-time highs, but we're a little changed on the S&P and NASDAQ, though looking to push for a second day of gains. Outperformance from small caps after they tumbled yesterday. Getting a help from this bond market, where the range yesterday was 11 basis points for the 10-year yield, jumping around quite a bit, but ending lower and pushing lower, again supporting some of the equities this morning. Speaking of getting jumpy, coming up next, investors apparently getting jumpy about Fed independence. That's the latest report from Wall Street. We're going to ask Morgan Stanley's Mike Wilson if he's seeing the same thing. This is Bloomberg Open Interest. Wall Street strategists say investors are becoming more concerned about Fed independence as President Trump seeks to impose his will on the central bank. JP Morgan analysts wrote to clients that, quote, markets have become more concerned over Fed independence as there are signs of a Fed inflation trade. Goldman Sachs analysts also noted growing concerns around Fed credibility. Let's get Morgan Stanley's take. Joining us now is Mike Wilson, who is the firm's chief U.S. equity strategist and CEO. Mike, thanks for joining this morning. Great to see you.
Great to see you.
So is this showing up in markets at all? At least on a headline level, there's been little drama.
Yeah, I think so. I mean, we've seen a little bit, maybe some term premium. I mean, in the bond market, I would say in the equity market, we haven't seen a major rotation yet to what I would say overly concerned about inflation running away from us. But this is part of a broader strategy. I mean, I think regardless of what happens with this particular event or, transition, the Fed and Treasury are working closer together and have been working more closely together because we have too much debt. Okay, and they've been doing this for, I would say, several presidents' terms and Treasury Secretaries' terms. And as I've been saying for quite a while, the Treasury is captured by Congress, right? Their job is to fund whatever Congress decides to spend. And the Fed, in many ways, is captured by Treasury's needs. So we've seen them work hand in glove in the past. And so that doesn't mean that they're, going to be manipulated and do something that's really crazy. But I think the Fed does have an obligation to help the government fund itself.
This is so interesting because there has been so much noise around Fed independence. Of course, we're going to get Stephen Miran's hearing today in Washington, and their concern about Fed independence is what I'm basically hearing from you is it's not a concern that you need a Fed who helps run this economy hot in order to tackle the deficit.
That's right. And by the way, I'd be nervous if the Fed wasn't somewhat totally independent because we do, the Fed needs to work to help us get out of this deficit problem. By the way, this is a bipartisan problem. This is not a Republican problem. It's not a Democrat. It's an American problem. We have too much debt. So the Fed should be working more closely with the government, with the administration to try and get our way out. And running the economy hot, as our note was titled this past week, is one of those strategies. So higher nominal GDP growth, maybe let inflation run a little bit hotter for a period of time, and then do more investment through tax incentives, and then hopefully you can kind of grow your way out of this debt.
Some people would say, though, that the risk with that is that you get the long end of the yield curve doing what it has been, and that is going higher, bumping up around 5%. What does it mean for equity outperformance? If running it hot helps equities, but potentially hiring long-term borrowing costs mean that it has the opposite effect of helping to loosen policy.
Well, that's right. And that's why I think the Treasury and the Fed together need to keep back-end rates lower, as they have in the past, right? So financial repression is not a new phenomena. There's different ways to do that, whether it's QE, yield curve control, they call it different things. But I'm pretty confident that if yields were to move back towards 5%, they would find a way to get them lower again.
So fiscal dominance means that in any of these circumstances, equities do well. Is that fair?
And to a point. I mean, look, they were priced for a lot of bad things in April, right? They were priced for a recession, which, by the way, in my view, I think we experienced a rolling recession that troughed in April. We've written about this extensively. And now we're into the next recovery. I call it a rolling recovery. So it's not going to be straight up for every sector. But the one part of the economy or one part of the market that has not really performed yet is the interest rate sensitive parts of the economy. Housing, areas that require borrowing costs to be lower. So that is the next stage of this. And I think, last week or 2 weeks ago, Jackson Hole, that's the first step to the Fed becoming more dovish. This is going to play out over the next 6 to 12 months. One of the reasons why we're still pretty bullish over the next 12 months.
One of the things you write about that I think is so brilliant is this idea of a presidency that's kitchen sinked, much like CEOs who kitchen sink, get all the bad news out of the way. So the sequencing, Is the bad news done then, Mike? Are we entering the period of deregulation, of tax benefits, and that adds rocket fuel to this equity market?
Absolutely. I mean, I think from a policy standpoint, the bad news is behind us. They sequenced it with a kitchen sink quarter in the first quarter that created the trough. And if you look at the policy, sort of initiatives from the administration and all the rhetoric starting really in the middle of April, it was all pro-growth. They really flipped the switch. And I think that was intentional. I think that's a very out of consensus view still. So, yeah, I mean, it's going to lead to, I think, somewhat of a boom next year in CapEx, in earnings. Corporations earning more money. They get a tax break now from the recent tax bill that was passed, and that recirculates into a higher velocity economy. The missing piece, once again, in this recovery is lower interest rates. That's the next phase.
But if it's all really concentrated in the first half of 2026, which we know the one big beautiful bill is, what happens when some of that juice starts to run out? When some of the CapEx spending on AI starts to run out? Does it mean a more challenging time at this time next year?
Well, that to be determined. That's a story for another day. Right now, we're focused on the next 6 or 12 months. Now, I do think there's some risk in the short term for some corrective activity because it's been straight up. And I wouldn't even be surprised if we get a sell the news on the first Fed cut, like maybe back-end rates get away from them a little bit.
And you'd be buying those dips.
I'd be buying those dips, but I think over the next 6 to 12 months, I mean, it looks pretty darn good from an equity perspective.
Okay, Mike, stick with us. We have a lot more to discuss. That is Mike Wilson of Morgan Stanley, and we are just moments away from that opening bell. A look at futures heading higher, just ever so slightly. So again, we are within 1% away from all-time highs. S&P up 1/10, as is the Nasdaq 0.1% as the Russell 2000 outperforms with lower bond yields this morning. Your opening bell coming up next. Just moments away from the start of trading, you're watching Bloomberg Open Interest. I'm Dani Berger. We are attempting to do a second day of gains, and at least if this price action holds, we will do just that. S&P and Nasdaq futures up 0.1%. Russell 2000 outperforms, getting some help from this bond market, which has been in rally mode since basically this time yesterday. We've had a lot of jobs data coming in over the past 48 hours, maybe mixed, maybe this low hire, low fire type of environment, but that's still supporting us. At the opening bell over the Nasdaq, we have IDEA. They are a bioscience firm. And then over here, we have Vontobel Asset Management, which, if I'm not mistaken, is a Swiss asset management firm, but they are celebrating the launch of their first ETF. All right, so we got the opening bell. Let's look at some of the price action of the major stocks this morning as they open up. Salesforce, that decline continuing. It is falling. Investors are seeking a stronger sales growth from its AI pivot. Figma, you can also see there, down 19%. It failed to meet a high bar for its first earnings report. And today, Broadcom's $730 billion rally will be tested with earnings after the bell. So that's the look of equities this morning. And again, this overall market continues to rally. Still with us is Morgan Stanley Chief U.S. Economist and Strategist Mike Wilson. So, Mike, we were just talking about how you're getting these strong tailwinds that you expect coming from policy, coming from an economy that might run hot. But if you look at the very moment we're in, we had ADP figures this morning that missed expectation. Challenger showing the worst August hiring plans on record. You also had the Beige Book saying that companies were fearful of hiring because of uncertainty. Is there some real tension at this moment between the macro outlook or the current macro environment we find ourselves in and equities near all-time highs?
I think there is, but when you actually look at what's been going on, I don't think there's any tension at all. I think you can explain this very simply, which is we're now getting all the lagging economic data on the economy, right? All that data is backward looking, particularly the labor data. And if you actually look at the revisions, right, the 2-month revisions, they all troughed in the second quarter with everything else that we look at, revision breadth for earnings, which are forward looking. Okay, so now if I had my druthers, okay, this would be the perfect setup. We get negative payrolls, we get some more negative labor data, the Fed goes, oh my goodness, we're actually in a recession. Every economist says we're in a recession, and then they really cut rates, okay? But the equity market's already figured this out 4 or 5 months ago, as usual. It's pricing forward, so we have a correction on that, but it's nothing like we saw in April. and then we resume the new bull market with a broadening out at that point. Because at that point, then the market can say definitively we're in an early cycle environment, the Fed's cutting, the yield curve steepens, and we get that real push through the broader economy.
Where does that broadening out happen? I'm just thinking about some of the earnings we had.
Yeah.
And you did see some of the retailers really flag some weakness and flag some issues when it came to tariffs. Walmart, for example, talking about higher prices every single week. Does the broadening out include them?
It does. Consumer good. I'll give you the list of areas I think that have been in a recession for really 3 years. Housing related, consumer goods, anything manufacturing related, okay, transportation stocks, particularly trucking and rails, commodity sectors have been in the doldrums, and then regional banks. There's been no C&I lending growth. So like there's a huge part of the economy which then will drive employment growth into 26 and 27, and also probably wage growth. So, this has been a very unique economic cycle. I think we figured this out a while ago. This rolling recession, we didn't trade it perfectly throughout because it's been tricky. But now I have more conviction in that thesis that we are now in a rolling recovery from the trough of the recession that ended in April, and the Fed will be late because they look at economic data, which is backward looking. Whereas the equity market is forward-looking because it looks at things like revisions and earnings revisions.
If the broadening out happens, does it happen at the sake of tech leadership, or does tech leadership continue as the rest of the market also catches up?
Well, it's interesting. Tech has also been in a soft recession, ex-AI. So we could see now more spending on traditional IT, particularly software, some of the areas that we haven't seen upgrades since really the work-from-home upgrade cycle. So you could actually see a broadening out within tech. As opposed to just 10 or 15 stocks that benefit from AI, now we actually see spending kind of diffuse across the broader economy.
So it's spending not necessarily on AI. Does some of the AI spending then, does that peter out?
Well, it's funny you mention that. We had a deceleration in AI CapEx starting last summer of 24, something we wrote about. That also caused a slowdown in Q1. So we're not going to see negative growth in AI spending, and now we're actually seeing a re-acceleration. So I would argue that AI spending went through, in their world, a mini recession, and now we're seeing a re-acceleration there. No, I'm growing more of the view that we're going to have a spending boom in 26 after this kind of continued softness through the rest of this year.
Mike, you just sound incredibly bullish. Is there anything that you're worried that could hamper this thesis that would make it not play out?
Well, I mean, if I can figure this out, the stock market's already figured it out. So that's the one thing that worries me a little bit, is that the stock market already knows all of this. And so we have gotten ahead of ourselves on some valuation metrics. And look, this strategy is not without risks, right? I mean, this is a aggressive strategy to run the economy hotter to try and get out of this debt problem. And who knows if it's going to work perfectly? But I think this is our best chance of getting the debt down as a percentage of GDP. So
we get an economy that runs hot again. This strategy, and it goes back to what you were saying, that you could get something like QE or something to make sure long-term bond yields come in. But if you do have a real clear working together of a Treasury, of a Fed, what about foreign buyers, not just on treasuries, but on American equity as well? Is there some damage to brand America because people have said Fed independence, it's sacrosanct, it's so important to the U.S.?
Well, I think there's a lot of things going on. I would say that maybe foreign investors shouldn't have as much capital in the U.S. because there's been this one-way freight train. The current account deficit's been negative, which means the capital account's been positive. So I would argue foreign investors probably own too much of the U.S., and diversifying back to their own economies is a good thing. One of the things that lower interest rates globally will do is it will stimulate the global economy, right? That's another area that's been in a recession for the last 3 years, is most of the global economy. So if that can come out of its doldrums, that can add to the story. And why can't foreign equities work in concert with U.S. equities?
Is there any tension of all this risk on happening in gold that is at all-time highs, of calls for gold to hit $5,000 by next year?
Well, I mean, gold has been probably the single best asset to have owned in the last 25 years, without question. But this gets back to the policies that we've had for the last 25 years, which is, print money, don't invest, overconsume, pull forward demand, and basically not have any concern about, the long-term value of the dollar. So maybe over time we can grow. If we grow out of this problem, then gold will become less attractive of an asset relative to other things. But the reality is stocks are also a good hedge against this strategy, right? So what's worked the best over the last 25 years is high quality stocks, that can grow through this type of an environment, and basically fiat currency hedges like gold or even Bitcoin.
Yeah, sure. I mean, hey, in the inflationary environment post-COVID, stocks still did really well.
That's
right.
right.
Speaks to that too. Mike, thank you so much for joining. This has been absolutely brilliant. That is Morgan Stanley Chief U.S. Equity Strategist and CIO, Mike Wilson. Let's get a check on the stock market just under 10 minutes into the trading day here in the U.S. And you have about even up and down stocks. Look, we are gaining. Not to a huge amount, up about 0.2%. What is leading us there? It does seem to be some of the Mag 7 this morning. Recall that some of these CEOs are going to be in the White House at the new, apparently, concrete garden, Rose Garden. That's at least what Michael McKee tells me it now looks like. So Amazon, Meta, those shares are higher this morning, as is Broadcom. Remember that they are going to be reporting earnings after the bell today. On to the downside, we have also tech leading us lower. Apple, those shares down 0.5% this morning. Meanwhile, Salesforce, again, that takes the cake of the top decliner. They had earnings which disappointed. Does their AI offering finally pick up steam at some point? It would seem that they're getting a real challenge from companies who are going at it alone and incorporating their own AI. So that's the look at the individual names. Now, when it comes to sectors, again, we are at a moment where you are looking at a S&P that's just up 0.1%. It's interesting to see healthcare. So some of the kind of more safety trades this morning is lower. Consumer discretionary, that's at the top, up 1.5%. I got to be honest, Mike Wilson was talking about an expected broadening in this market. The trade kind of looks like that today. It's not infotech that's carrying us higher like it did yesterday. In fact, tech as a sector, you can see is down 0.2%. But of course, the communication sector, which has a lot of Mag 7 in it as well, is also the second best performing sector. Okay, coming up on the show, Ollie's Bargain Outlet continues its expansion across the U.S. The company's CEO will be joining us next. You are watching Bloomberg Open Interest. Let's get you some top calls, some of the analyst action in focus this morning. First up, MoffettNathanson upgrading Apple to neutral, seeing a limited downside as key headwinds continue to fade away. Apple weaker in today's trade. Next up, Seaport Global downgrading AMD to neutral. Shares fall 2.6%. They say recent channel checks indicate slowing progress within its AI accelerator business. Finally, Evercore upgrading Brinker to outperform. That highlights an attractive valuation and improving customer satisfaction measures. Shares up 5%. Now, price targets keep rising for Ollie's Bargain Outlet. Since reporting earnings last week, 10 analysts have raised targets by an average of 13%. The stock has been on an impressive run, up over 40% over the past year. Joining us now is Eric van der Valk, CEO of Ollie's Bargain Outlet, a U.S. discount retailer with more than 500 stores across 30 states. Eric, thank you so much for joining.
Thanks for having me, Dani.
So you also had your earnings last week. That looked very robust. I would love to know what's driving that. Is that consumers trading down to Ollie's, or is it already your current base just spending and robustness there?
It's all of the above. So we are seeing a trade down, very solid with low middle income and higher middle income consumers, and even high income. So we define that as 50 to 100,000 in household income, or even 100 to 150,000 household income. We're also seeing growth in younger consumers under 50 years old, which is great for us.
So with that, because there's a lot of questions as to when retailers report, is this something of a moment of economic stress? If you are seeing that down trading, does it to you indicate greater economic stress?
Perhaps. We do see that in the way customers are behaving, and our concern for customers as we enter the back half of the year that perhaps that pressure will intensify. In our business, we see customers shopping more intensely for consumable product, consumer staples, products they need. They're shopping close to need, which is an indicator that the consumer is under some stress.
Well, businesses under stress too, trying to figure out how to navigate tariffs. I think as the start of this year, it was something like 20% of your products were imports. Just the day-to-day of doing business with things like de minimis tariffs ending, confusion over what absolute levels are. How difficult is it to put a price tag on an item right now?
It's challenging, but our business model is very fluid and flexible. So we're in a great position. We can make a decision not to buy an item if we can't offer the right price to the consumer, and we could buy something else. Our customer doesn't have an expectation that we'll have anything in particular in stock on a day-to-day, week-to-week basis. That gives us the flexibility to just not buy it, not import it. if we can't achieve the right price and the right markup, ultimately to make us profitable.
Given that, again, you're just so known for value and discounts, does that mean that you are avoiding at all costs trying to raise prices, or are you doing that on the margin?
We are avoiding at all costs to raise prices, but we are a price follower, and we maintain price gaps to the market. We're fiercely committed to making sure we are the absolute best price in the market. It will continue to do that. Again, we can substitute items and even categories to ensure that we are the best price in the market and not necessarily follow the market in price increases.
On your earnings call, you also talked about this idea that bankruptcies and store closures that are happening right now are a big benefit to you too, because you can look into expanding into these spaces. Just the level that you're seeing at the moment, if we compare it to other moments of stress, I mean, the most recent of one being COVID, how does it stack up with these retailers that are closing and, again, advantages you're seeing there?
Sure, yeah, it's a great moment for us. 43 years of business for Ollie's, and there's always been enough closeouts in the market for us to be able to fuel the demand of our consumers. In this moment, it's bankruptcies and it's tariff-related uncertainty that's created even more closeouts. When you look at the market share opportunity for share of wallet with all the different companies that have closed, gone bankrupt, or closed stores, tremendous opportunity. It's also an opportunity to pick up people, human capital, people who are without jobs, and hire them into our new stores. We accelerated growth this year, opening 85 stores on top of 50 last year was an opportunity for us to hire more people and provide tremendous value to that many more communities across the country.
I have to say, Eric, I also think part of the reason it's so fascinating to be in your seat right now with a really iconic American brand started in the 1980s is that for so many brands closely tied to this country, you're seeing a real interest from the online community and from the president, be it calling out the Cracker Barrel change of logo or Sydney Sweeney selling jeans for American Eagle, which I'm going to assume you're not hiring any actresses to sell all these bargain brands. But how do you think about just approaching the public when it does seem like there is this greater awareness, again, be it from the White House or online, with what companies are doing?
Sure. Ollie is actually one of our founders. He's a real person, and his image is all throughout our stores. It's a very quirky, kind of funny, friendly brand, approachable. And Ollie is one of our founders, is, kind of funny looking older man. And we love him and our customers love him and we lean into him and have no plans to make any changes in terms of our iconography and our brand personality.
But again, when you think about changes, do you have in the back of your head potentially that this could have an audience of the White House? Does that factor into decision making at all?
It does not.
Okay.
It does not. No. We find it maybe humorous to talk about, but it's not really factoring into decisions that we make.
Hey,
our customers give us feedback on Ollie. They love Ollie.
Well, just quickly on the customers, you don't want to raise prices. You can be really flexible. I just wonder what levers you're looking at pulling right now to deal with some of the tariffs on items that you do want. How are those conversations working with suppliers and elsewhere?
Sure. Our suppliers are great partners, and we have a tremendous buying acumen to work with them, partner with them to ensure that we can bring the right value to the marketplace. So they participate. Again, we choose potentially not to buy. We substitute items, and we watch very closely the price comparisons to make sure that our value gaps, our price gaps are maintained or even wider.
All right, Eric, thank you so much for joining, and I'm sure Ollie is happy with this interview that his face will stay the face of Ollie's. That is Eric Vandervalk of Ollie's Bargain Outlet. Now, coming up, speaking of American Eagle, those shares climbing to an intraday record, literally because of Sydney Sweeney, the CEO saying that her jeans sold out everywhere and they picked up customers in every single county of the U.S. We're going to have that story for you next. You're watching Bloomberg Open Interest. American Eagle shares are rising in the early trade. You can even say they're soaring, a pun that I think our production team missed, but that's okay. Shares up 32%. The apparel brand that famously made an ad with actress Sydney Sweeney saw shares skyrocket in late trading yesterday. It reported a quarterly sales beat. For more, we are joined by Bloomberg Managing Editor for Global Business in the Americas, Shelley Banjo. Shelley, is this literally due to Sydney Sweeney, the fact that they did so well?
I think that it's part of it. I mean, people are talking about this brand in a way that they haven't in probably years.
Well, okay, it came with a lot of controversy, though. So what does this mean for other consumer brands maybe looking to replicate the success?
Yeah, I mean, I don't think they did it on purpose to, like, bring up the controversy. I think that they really tried to do, you know, a good brand, or at least that's what they say that they tried to do. But they leaned into it and sort of kept going with it and realized that they had a moment here that they could step into, and then followed it up with another big brand partnership with Travis Kelce.
Does it tell us anything about the consumer and the health of the consumer at this moment? Maybe the fact that there is still a disposable outcome, especially with younger customers who want to buy the same thing that Sydney Sweeney or Travis Kelce are wearing.
Yeah, I mean, I think people want to buy the stuff that's cool, and that's always been the case. And so the only way to get people spending in an economy like this, where people are a little bit uncertain or teetering, you know, one way or another, is to make a big deal about it, make it really cool. And so this is sort of, you know, they a little bit of luck, a little bit of you know, really leaning into it at the moment.
Making things cool. I think that's kind of an interesting theme when you look at the likes of Macy's, for example, trying to do a turnaround. A lot of these retailers hoping to achieve a turnaround. How much are we in an environment of a fickle customer that isn't just going to buy, that you really need to show up and give them offerings with taste changing so quickly?
Yeah, I mean, I think that's exactly the playbook right now. They really, the brands that are doing well are really leaning into it and really trying to say, okay, what can we do, even if it's one thing, if it's one partnership with one buzzy thing or one buzzy person, how can we give people a reason to actually buy something right now?
Speaking of buzzy things, Gap announced that it's going to expand beauty items and accessories in its Old Navy stores. I'm going to be honest, if I think about buying, like, I don't know, a face mask or something, Old Navy would be so far off the list that maybe it doesn't even factor. Why push into this area for Gap?
Yeah, this is a huge area, beauty right now. I mean, it has been for the last few years, particularly face care and skin care, especially with the tweens, the teens. This is where they are dragging their parents, you know, screaming to Sephora, being like, give me your credit card, let me spend some money over here at Sephora. And Old Navy wants to tap into some of that.
It wants to tap into it. How much of this is also just for a grab of people who want that, but are also looking to trade down, that maybe don't want to spend as much as a Sephora trip would set you back?
Exactly. I mean, when you want, you know, that little luxury, it's the whole lipstick index, you know, concept where I can afford to buy something like this. Maybe this will bring me into the store. Maybe there will be a buzzy TikTok moment at Old Navy that'll bring people in to buy these things.
Is this all it is now, just TikTok driving sales, Shelley? Is this the new world we're in?
It really is. It really is.
But it's scary because it also means, to your point, that literally tweens are like, what anti-wrinkle cream do I need? And what's my, like, 10-step skincare routine for children whose skin is completely fine?
You talk to most 10, 11, 12, 13-year-old, especially girls, but also boys, they know they have a skincare routine, probably better than you and me.
Probably. Shelley, that's terrifying. But I guess good news for Gap that's expanding into there. Shelley, thank you so much for joining. I really appreciate it. That is Shelley Banjo. By the way, in the next hour, we're going to hear from Gap Inc. CEO Richard Dickson. He's going to be joining us, sitting down with Lisa Abramowitz at 10:30 a.m. New York time. We'll see what he has to say about expanding into beauty and accessories. All right, a check on stocks this morning, about 25 minutes into your trading day. Again, we are moving higher, not by a huge amount, 0.1% for the NASDAQ. S&P goes up 0.2%. And see the Russell 2000 outperformance there again with more easy and stability environment in this bond market. Bonds this morning, yields are lower for your 10-year yield, down by 3 basis points. We've had a lot of jobs data coming in. ADP worse than expected. The jobless claims, though, those looked mostly steady, but challengers, that one really looking tough. Hiring plans for August. They were their worst August ever since the data going back that Challenger was trying to capture. We're talking with Mike Wilson earlier, who said that cuts are coming, and this is a Fed and a government that is going to run the economy hot, and that means any of those dips you can buy. Well, coming up, we're going to hear from Carin, head of portfolio management at Fiduciary Trust, plus Thoma Bravo's Seth Boro on infrastructure software and cyber investments. And live on Capitol Hill, Stephen Miran, President Trump's pick for Fed governor, will be testifying. We'll bring you that in the next hour. You're watching Bloomberg Open Interest. Minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller off this morning. It is a market looking for a second day of gains with a lot of jobs data coming in. We had ADP earlier as well as jobless claims. In just moments, we're going to have breaking across the terminal ISM services that appears to be hitting just now. Let's get over to Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what are you seeing?
Well, mixed news again, Dani. This time the headline ISM services number comes in at 52. That is up from 50.1. And the new orders index is up to 56 from 50.3. But under the hood, still some issues. Prices paid 69.2, down from 69.9. But that's still an issue in terms of the level of prices. Employment still weak, 46.5. It's a tick better than the 46.4 last month, but it does suggest that service industry hiring has been weak again in August, and that would mean less chance for a strong report tomorrow. And we saw that with the ADP number, of course, coming in with only 54,000 jobs. So the ISM services numbers are mixed, a little bit of an improvement in business and orders, but the production index is at 55 from 52.6, so not too bad at this point. It's the hiring and, of course, the prices paid, the tariff impact that matters.
And Mike, again, maybe that's keeping in line with enough of some of the messages we've gotten this morning. So we're looking at S&P 500 trading session that's still holding on to gains, and bond market that's also still holding on to gains. In any moment from now, Mike, we're also expecting the beginning of Stephen Miran's confirmation hearing where you are on Capitol Hill. What are the expectations for that? What might we hear from Miran?
Well, the expectation is that Miran is going to give a fairly anodyne opening statement. We've already got that. He pledges, in this case, to be politically impartial and not to let his views influence what the economics tells him about monetary policy. However, of course, Miran has had a history of being very political on behalf of Donald Trump, and even before he came to the Trump administration, making suggestions for giving the president more power over the Fed in a paper last year. So they will have the hearing today, and then, Dani, probably try to get floor action next week. Not easy with the way their calendar works, but they need to do it next week in order to get him in place for the meetings next Tuesday, the Tuesday and Wednesday afterwards. His vote won't be relevant, but he will be a voice for the president, because at this point, the Fed is going to move and do what Jay Powell suggests, and right now he's suggesting that they will cut rates. And then the question is, how will he be received? He's a guy who has suggested major impacts on these people's jobs, the other Fed officials cutting their terms, making the president able to fire them at will, and in particular, in his paper last year, saying not so nice things about Austin Goolsbee and Mary Daly. So it'll be interesting to see if we can get a feel for what it's like when he walks in the door there.
Mike, also this crossing from the Wall Street Journal just moments ago that the DOJ has opened a criminal investigation into Fed Governor Lisa Cook. Just as we're talking about this idea of what does the shape of the Federal Reserve, of the FOMC look like, how could this change the current dynamic and attempts to oust Lisa Cook if the DOJ is opening a criminal investigation?
Well, it's only opening an investigation, and this is perhaps the least surprising news we've had from the administration in a while. When Donald Trump said fire her, you knew that his people were going to do everything they could to try to get her out. The question is, how long does it take for them to come up with some sort of indictment, and will she get indicted? Will the government be able to get a grand jury to do that? We've seen a number of cases in Washington over the last week or so where grand juries refused to indict people that the administration was going after. It won't affect the case, at least in the short run, for a temporary restraining order. We do have a deadline today for the last filings from the lawyers for both sides, and then the judge can rule, perhaps today, more likely tomorrow, on whether they can keep her in office until at least the Fed meeting is over, and perhaps as long as it takes to litigate all of this through the courts. But the one thing I can predict here is that if Stephen Miran is asked about this, and Democrats have suggested they will today, he can probably say, I'm not going to talk about it because now it's a legal case.
Fair enough. Hey, Mike, thank you very much for that. And we're going to catch up with you throughout the hour. As that hearing kicks off, you're seeing right there the Senator Tim Scott, the chair of the Senate Banking Committee, opening up that hearing again. We will bring you any headlines as they come and when Stephen Miran speaks. Now, joining me is Carin. She's head of portfolio management and equities at Fiduciary Trust International, a Franklin Templeton company. Carin, thank you so much for joining.
Thank you, Dani.
We just had Mike Wilson of Morgan Stanley on the show earlier and saying there is this concern about Fed independence. He says it doesn't register for me, and if anything, a Fed and Treasury working hand in hand has happened before, and it's okay for this equity market. For you, in evaluating where risk assets go from here, should Fed independence be a real question and cause of concern?
Sure, that's a great question. I think, it is, when we look at equity valuations at this point, trading at 23 times earnings, it is difficult for me to try to align that with where the Fed is heading. But the Fed has two mandates, right? Employment and also stability and inflation, right? So I think that the Fed's mandate is a little bit different from trying to manage the markets. I do think that we are at a point where the markets and the economy is somewhat, I do think that there is a bubble building in asset prices, but we're in the building stage. And I think that, we have to look for signs to see whether that is actually going to change at some point.
I love that, because kind of the best thing you can do when a bubble is building is go long, right? Is to ride the bubble. At what point do you get concerned that it goes too far? You said that you're monitoring for any changes. What are the signs you're looking for that a bubble is run too far?
Sure. So, when we look at the markets today, we know that a lot of market gains and earnings is being driven by technology and the spending on artificial intelligence. And the Mag 7 stocks today contribute over 30% of the stock market's gains. It also contributes over 30% of, excuse me, in CapEx. So, I think that it's important to recognize this concentration and recognize that this is an area where we think that when CapEx starts to slow, that's probably one area that we would get concerned about.
Yeah, Carin, I'll let you drink some water. And if you are just joining us, we are about 30 minutes into your trading day. Here's a look at equities. You can see two-year yields coming down across the curve. We are moving lower with equities moving higher. Carin, this idea of bond market sensitivity, because we saw it really in force at the start of this week when you had 30-year yields bumping up around 5% and equities selling off. That is calm, but what do you see as the continued sensitivity to this equity market, to what bonds are doing, especially the long end of the curve, with real questions around deficits and inflation?
Sure. So credit and liquidity is a big driver for financial markets, and it's definitely had an impact in terms of driving equity returns. I think that there's a greater sensitivity in terms of rates to small cap versus large cap. Large cap stocks are less sensitive to rates, but obviously still a degree of sensitivity. I think small cap is just more vulnerable to the potential changes in interest rates. And if we were to see a cut in rates, that could actually help a small cap outperformance. And we've seen periods of that occur before, because the credit environment is just a lot more tied to small cap as opposed to large cap that generally have stronger balance sheets.
Carin, one of the other things that you've been writing about is this idea that earnings growth was boosted by front loading of purchases ahead of tariffs. With the highest tariff rate in 90 years. Does that end now, this front loading? Does that mean that you start to see some real weakness perhaps coming from earnings with that to the side, with that over and done with?
So we do expect that the impact of tariffs will probably play out over the next couple of quarters. We do see that in Q1 and Q2, earnings were a lot stronger than what markets expected. Many companies surprised to the upside. In fact, about 80% of companies surprised to the upside, lifting earnings expectations for the quarter and also a little bit, for the year. We're sort of, in terms of earnings expectations, back to about 12% growth for this year, before, sort of to the level before Liberation Day. And we do expect that companies will start to deal with tariff increase in terms of their costs. And we did hear a number of companies talk about raising prices to manage some of these tariffs. So we think that what we saw in the first 2 quarters is not reflective of some of the risks around tariffs, and that those risks are probably still ahead of us.
When you do hear companies talk about some of the risks, it is this feeling that they're getting really punished. Dollar Tree, for example, reporting yesterday, their same-store sales growth was 6.5% for the recent quarter, which is strong. I mean, that's stronger than Walmart. But they talked about some of the weird timing around tariff impact. And the shares sank. How unforgiving is this market when you get a company that comes out and in real ways talks about the tariff impact?
Yes, it shows the market's sensitivity to the risks around tariffs. So I think that we are hearing, and stocks are reacting because this is probably one of the primary concerns for the market in terms of what are tariffs going to do to earnings. And so when companies are talking about how it's going to impact their business, then there's much greater sensitivity to that in terms of share prices. Especially, I think that there is a concern about the consumer overall slowing down spending. And we know that the consumer has been very sensitive to price increases. And we do have a, K-shaped economy and K-shaped consumer. The wealth effect is helping the higher end, but the lower end is much more sensitive to price increases.
All right, Carin, thank you so much for joining this morning. It was a pleasure to speak with you. That is Carin Pay of Fiduciary Trust International, a Franklin Templeton company. Coming up on the show, Optimism returns to Dealmaking. We're going to speak with Thoma Bravo managing partner Seth Boro, and we'll continue to monitor Stephen Miran's confirmation hearing on Capitol Hill. You can see Senator Warren giving her opening remarks, and you can also watch the full hearing on your terminal Live Go or follow our live blog at TLiveGo, but nothing's happening yet, so don't turn off your TV. Pay attention here. You are watching Bloomberg Open Interest.
With Republicans, including Republicans on this committee, for years on common sense reforms to make the Fed more transparent and more accountable to Congress.
Now to high interest, a look at what's making headlines around the world. Citigroup entrusting its wealth business about $80 billion or so worth of assets to BlackRock in a new partnership. As part of that agreement, BlackRock will receive management fees while Citi will keep fees for advising clients. The new arrangement is expected to be completed by year-end. Elsewhere in banking, Goldman Sachs announced that it will invest as much as $1 billion in T. Rowe Price. The bank also said the two companies will team up to sell private market products to retail investors. Salesforce also delivered a disappointing outlook for quarterly sales growth. That forecast suggesting that its AI product isn't paying off as quickly as hoped in the face of intensifying competition. Those shares down just under 7.5%. And Optimism returning to deal-making, especially in tech and cybersecurity. This year has seen massive transactions from Palo Alto's $25 billion takeover of CyberArk to Google's $32 billion purchase of Wiz and the hotly anticipated IPO of SailPoint, taken public by the world's biggest tech buyout firm, Thoma Bravo. And I am pleased to say that joining us now is Seth Boro, managing partner at Thoma Bravo. Seth, wonderful to see you. Thanks for coming in this morning.
Thanks, Dani. Great to be here.
So as I just mentioned, we've seen some really massive deals this year, and it feels like we have entered into the year and the environment of mega deals in cybersecurity. Do you think it has further to run?
Cyber, which is a main area of focus for us and a long-standing area of investment, has been for us such a great place to invest. It's an industry that, for good and bad, continues to grow. Obviously, the breach landscape has evolved over time and rapidly. The zero-day threat today is, as invasive as it's ever been, and companies need to respond real time. And so, what we see today is a market with a lot of growth ahead of it. There are so many different threat surfaces to protect. A lot of strategic interest in the area in general, and we expect it to continue to be a main area of focus for us from an investment perspective.
And again, a lot of interest often means that big players like Google are now participating in the M&A. What does that do to competition for the highest quality of assets? Does it mean that valuations just head higher if, again, you have to compete with industry players who are willing to spend on big paychecks?
Valuations in cyber have always been high. For as long as I've been investing in the industry, it's been a premium valued sector, and that's related to the growth in the market. It's an area and an industry that you need to be really highly innovative in, and so it's not surprising, that you're seeing large strategic buyers buy into the space. Strategic buyers can't buy everything, and there's always a moment in time where there's an asset or investment that is really, really well suited for what we do. We try to buy market leaders. We try to buy the most innovative companies. We really believe in best-of-breed security vendors and partnerships in the industry to create meaningful platforms. And our view is that we can compete successfully with the large strategics who are building, very large platforms, and we see that and have continued to see that over the years in the market.
Just as we're talking about, again, these large strategic players and Google specifically, there was that really interesting court case earlier in this week that basically said that the reason Google doesn't have to divest Chrome is because of AI and the threat there. It's this real feeling that the marketplace is evolving faster than the regulatory legal system. AI, obviously a huge concentration of Thoma Bravo 2. How does that tension with the regulators play out going forward from here?
I thought it's been an interesting week in that regard. Obviously, the regulatory environment has shifted over time, but I give the court credit for recognizing that AI, and really when we talk about AI, it's Gen AI, that's the world that we're in today, has created thousands of new companies that are trying to compete in all these different markets, and cyber is one of them. It's changed the landscape very quickly. I think, as the judge said in that case, it's really hard to predict the future. And so I thought that it was an interesting analysis and just appreciation for the evolving market today. As it relates to cyber, Gen AI is creating all sorts of opportunities from a product perspective to create new product, to defend against new threats, to make companies more efficient from an enablement of talent perspective. And so we're living in a world right now that's changing on a day-by-day basis. And so I thought it was really interesting that in analyzing that case, that was appreciated and realized because I think it's the reality of where we sit today.
Who are the winners of that? You're saying all these emerging AI companies come in. Is it the mainstays? I mean, I was talking about Salesforce earnings earlier, and people weren't adopting their AI products as quickly as had hoped. And in things like cybersecurity, is it new emerging AI companies specifically, or is it existing players that try to incorporate AI into their current offerings?
Well, the reality is things take time, right? We focus on selling our companies that we invest in, focus on selling into the enterprise. And enterprises will take time to incorporate in all of these new technologies that are being introduced. We have a strong belief that there's a very interesting incumbency advantage as it relates to Gen AI. Data is very important as people train models to put new products into market. So what we see from our portfolio today is that very quickly they were able to deliver to their customer base some incredible products to enhance what they already had delivered them and to expand their platform in very meaningful ways. And that was on the back of Gen AI. And they have many, many years of data in certain verticals or horizontal markets or cyber markets that they can use to deliver this incremental value. So I think it's really hard today to sit here and say who will ultimately win.
Right.
I think we're seeing a ton of venture investment into the market. Ultimately, for us, we appreciate that innovation, right? That innovation for us has driven, a large part of tech and ultimately the companies that end up in our portfolio.
Yeah. Well, just on that, Seth, because there's been a lot of excitement to the point where the Barclays head of M&A said that in the next year we could see a $100 billion deal around AI. Something like triple digits, I gotta say, brings to mind Sam Altman saying that, are we in this moment where markets and investors are getting overexcited? Yes, I think so. If we are talking about triple digits on deals, are we overexcited about AI at this moment?
Well, I think the investment industry has been known to get excited, potentially, ahead of the operational capabilities of some of these companies. But we're so early in this Gen AI evolution that I think, we'll for sure see that. I don't know if we see it over the next year, but we're definitely headed that way.
Oh, you are seeing a triple-digit price tags on deals.
It's already happening.
Okay, fair enough. Is it happening for Thoma Bravo? Is this where you're headed to? Maybe not. You don't have to answer that one. But look, we have just been littered with examples of people saying that for the second half of this year, deal volume in general will pick up. Goldman saying also that deal volume in 2026 will be a record. Thoma Bravo has been so active, even when others haven't been active. Are you about to return to a more robust environment for everybody? Are we headed to record figures coming for 2026 when a lot of people at the end of last year thought this would be the year for that?
For us, in every market cycle, we tend to be active. We always talk about the fact that we don't buy the market. You know, we're buying individual companies, and at any given point in time, there will be a business, whether it's a platform investment for us or an add-on acquisition, that suits our strategy. We really try to buy through cycles in that regard, and so it's hard for me to speak to what our peers will do or what the industry might do, but we're always looking to deploy capital. And when you do it at the individual company level, what's happening in the market isn't as important to us because we really are focused on fundamentals, the operations of the business, buying into great sectors. And we always say the time to buy a great company is when you can. And so for us, any time tends to be a good time, so long as the price is in a zone that can get the necessary return for our investors.
Seth, that is a great note to leave it on. Thank you so much for coming in. It was wonderful to see you this morning. We'll have to do this again soon. It's been too long. Seth Boro, Thoma Bravo managing partner. Now to Washington, D.C., where we are awaiting the opening remarks from Fed Governor nominee Stephen Miran. In a confirmation hearing, we are looking at a different potential nominee talking at the moment, not for the Fed. But let's bring in Bloomberg's Michael McKee, who is on Capitol Hill again, waiting for that testimony from Stephen Miran. Mike, what do we know at this point as to what Miran is going to be saying when he delivers his opening remarks to the Senate Banking Committee?
Well, his opening statement was released last night because nominees' statements in these situations are generally kind of anodyne. And for the most part, that's what we've heard from the first two. And we will hear from Stephen Miran, the honor to be here and the honor to serve the government, that sort of thing. He does say that he is going to focus on being impartial, not bring political views to his monetary policy making. In his statement, he
Mike,
says...
I'm just going to jump in because we can hear from the nominee himself, Stephen Miran. Let's listen in.
Nominated by the President and considered by this esteemed group. As 32nd Chairman of the Council of Economic Advisors, I've advised the President and his administration on fiscal and regulatory policies designed to achieve full employment and stable prices. These goals are declared in the Employment Act of 1946, mirroring the mandates in the Federal Reserve Act. And the responsibilities of both the CEA and the Federal Reserve to advance America's economic prosperity are further developed in the Full Employment and Balanced Growth Act of 1978. The two organizations share common goals, but enjoy different means. I've been studying and writing about monetary policy and macroeconomics for 2 decades, beginning with my doctoral research in economics at Harvard. I am thankful to have been advised by my CEA predecessor, Marty Feldstein. For the majority of my career, I was active in public markets, particularly interest rates and currencies. I learned firsthand the substantial sway that monetary policy and market structure hold over the price and availability of credit. But those borrowing costs are not just a Wall Street phenomenon. Purchasing a car or a home are major milestones in pursuit of the American dream. Affordability and interest rates affect decisions to have children or start a business. The flow of credit and liquidity is central to America's banking system, and by extension, global capital markets. The Fed's role safeguarding these is of paramount importance. In my view, the most important job of the central bank is to prevent depressions and hyperinflations. Independence of monetary policy is a critical element for its success. Given the central bank's outsized role in the economy, it's no surprise that outsiders have opined on its decisions for decades. However, if confirmed, I plan to dutifully carry out my role pursuant to the mandates assigned by Congress. My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship. The Federal Open Market Committee is an independent group with a monumental task, and I intend to preserve that independence and serve the American people to the best of my ability. But the Fed's operations expand well beyond this scope. Managing financial system liquidity is a complex exercise requiring regular fine-tuning. The Fed oversees the most important global financial institutions. It sets varying prices of money for borrowers and lenders, including other central banks. The ultimate composition of the Fed's balance sheet is an open-ended question. Effective monetary policy is critical to the well-functioning of the economy, the preservation of America's robust capital markets, and the growing prosperity of our nation. Congress wisely tasked the Fed with pursuing price stability, maximum employment, and moderate long-term interest rates. If confirmed, I will transparently and honestly work towards that pursuit with the goal of preserving a stable and healthy economy that benefits all Americans. Thank you, and I look forward to your questions.
Thank you. Mr. Pickerton.
Chairman Scott, Ranking Member Warren.
That was Stephen Miran, President Trump's pick for Fed governor, speaking on Capitol Hill. Other nominees up at the chair now speaking as we await two more and then congressional questions to Steve Miran. Bloomberg's Michael McKee joins us now from Capitol Hill. So, Mike, it was the opening statement that we expected, but perhaps we zero in on this line early on in one of the first paragraphs saying that independence is a critical element for its success, talking about the Fed. What does it mean to have Steve Miran out of the gate emphasizing that?
Well, in a way, he almost has no choice because independence is baked into what Congress said when they created the Fed. And of course, he has to win confirmation, but it does stand somewhat in opposition to what he has said before and certainly what his boss, the president, has been saying. And so it's going to be interesting to see how the questions are phrased around that. Miran wrote a paper last year suggesting that the government nationalize all of the Fed banks, that governors appoint the boards who pick Fed presidents, which would give more political control to people in politics, and also that the president should be able to fire workers at the Fed, presidents, governors, or staffers at will, which might lead to a major turnover of Fed staff. So he's definitely advocated more politics in the in governance of the Fed, and he's certainly been outspoken about that as chairman of the CEA before he knew that he was going to go up before the Senate and be nominated. So I assume he has leave from the president to say what he said, but we don't know exactly what he means by Fed independence.
Fair enough. And Mike, as you point out, at some point we will get these senators from the Senate Banking Committee asking Stephen Miran questions. Who are you looking out for? What sort of grilling or not might he face?
Well, of course, you always have to watch for Senator Elizabeth Warren. She's the ranking Democrat on the Banking Committee. She's already, in her opening statement, accused the president of trying to put lackeys in place who would do his bidding. So you know she's loaded for bear in her questioning today. We'll watch some of the others. Jack Reed, maybe, from Rhode Island. We'll see how many of them want to take the fight to Miran because they know they don't have the votes to stop him. So this is their best opportunity to score some points, even if they can't block the nomination.
Fair enough. Hey, Mike, we're going to check back in with you when that Q&A begins. That is Bloomberg's Michael McKee on Capitol Hill, and you can watch that full hearing on your terminal Live Go, or you can follow our live blog at TLiveGo. And let's get a quick check on markets because we're now an hour into your trading day, and you have seen equities struggle to hold on to their gains, but they are still up about 0.2% for the S&P at one point. We did move lower by we did move flat. The NASDAQ, that underperforms this morning, but recall it was yesterday that tech lifted us higher. That was after the ruling from Alphabet saying that they didn't have to sell off their Chrome browser. It was the thing that lifted us higher. You are looking at a 10-year yield that's lower by 0.3%. A bond yield, by the way, a 10-year yield that had a range of 11 basis points yesterday at one point. The 30-year yield going to 5%, but it is lower, and that is helping an equity market rally. Now, we head to the 32nd Goldman Sachs Annual Retailing Conference in New York. Bloomberg's Lisa Abramovitz now joined by the Gap Inc. CEO, Richard Dickson. Hey, Lisa.
Hey, Dani, thank you so much. I am here on site at the Goldman Sachs conference with Richard Dickson, the CEO of Gap Inc., encompassing Gap, the namesake brand, as well as Old Navy, Athleta, and of course, Banana Republic, which you are decked out in today. I want to start. It's great to see you. Thank you for being here. I want to start with the announcement that you put out today about expanding the beauty and accessory line in stores later this fall, maybe at Old Navy first. Why now?
Well, I think, one of the reasons why now is also sort of a reflection of where we've been. And as you know, we've been working really hard at fixing fundamentals of our business. Our core assets, as you mentioned, Old Navy, Gap, Banana Republic, Athleta, these are iconic American brands, but ultimately brands that we've been working to rebuild the core category apparel into a consistent growth. We've proven that at this point. In fact, we reported our last earnings, 6 quarters of comping the comp. Our 3 largest brands also comping. We're growing our share, which means the consumer is voting for us from a financial perspective. We've stabilized, if you will, the middle of the P&L, and we're starting to see growth. Cash balance really strong. So we're in a very good position now where we're sort of moving into the next phase of our transformation strategy, which is about building momentum and accelerating growth. And when we look at our brand and portfolio, there are categories within our business that are small businesses that could be much larger, important businesses. And those two are beauty and accessories. High margin, really exciting categories. Customers resonate with those categories in our stores already, and so we know we've got that relationship with consumers that are looking for that product in our stores, and we can really dial those up to be meaningful businesses for our future.
The impulse purchases as you get to the counter. You talk about the turnaround plan, and you have had 2 years, and there has been meaningful growth in a number of the brands. I'm just wondering, you've talked about the tariff-related hit to profits being up to $175 million. How much has that set that turnaround plan back?
Look, I think in any business, you're always dealing with things that are not necessarily in your control. And I think the reflection of a healthy company and a healthy culture is how resilient that culture is, how they remain agile and flexible to deal with circumstances that come our way. And tariffs is one of those circumstances. It certainly is a headwind. But we've done a really good job mitigating as much as we can at this juncture. We did also commit in 2026 to see no further degradation in the context of the impact of tariffs. We have our mitigation strategies that we've shared, working with our suppliers, diversifying our manufacturing footprint, ultimately challenging our own choices of investments, not compromising our long-term integrity, but being choiceful about when we invest and how much we invest, and making sure at the end of the day that while there are price increases that are part of our pricing strategy every year, that we don't lose the value proposition to the consumer that we've been really reigniting across our portfolio.
In order to maintain margin, how much are you looking at efficiencies, Reed, either cutting back on staffing, not hiring, or even, looking at using technology to increase the output with fewer people?
Yeah. Well, look, there's a lot of componentry that goes into margin. What you could see in the context of our transformation, and arguably even longer than that, our history, we're operating right now at gross margin highs. I mean, we've had incredible expansion of our gross margin. Now, we've done that through real savings and efficiencies. We've done it through better assortment planning, cutting our inventory, pulling back on unprofitable doors, through that merchandising edit and better storytelling using our playbook as a form of execution. We've created more demand and more interest in our brands and are driving more full price selling, less discounting, and more resonance. And so those are the most important healthy components of building back our margin. And I think as you look at our margin expansion over the last couple of years, we believe that we're sort of at a historical high in reference point, but that there's more opportunity for us as we get more efficient and as our brands get more relevant in the marketplace.
You keep talking about relevancy, which goes to the core of your cultural relevancy, and bringing cultural relevancy back to the Gap Inc. brands. Is it more difficult to bring relevancy or adapt to current fashions without, say, Asia as the reliable supplier, the manufacturer, having to rejigger supply chains at the same time as remaining relevant and current?
Yeah, look, it is all a challenge. And retail, as we've talked about, is a challenging business. It is about the detail. But at the end of the day, it's about the consumer. And as long as you focus on the consumer's wants, needs, driving narratives that connect with consumers and product that ultimately appeals to consumers, you can create a winning business in any complex industry. And fortunately, again, our team and talent, particularly in the supply chain, our merchandising teams, creative teams, they're driving this playbook with agility and conviction, and we're winning in a marketplace that's clearly challenged.
And we have seen the growth in a number of the Gap brands. Today, we also saw American Eagle come out with better than expected earnings. Their shares rose the most ever after the Sydney Sweeney advertising campaign. Highly controversial, also highly profitable for them.
Yeah.
Does that make you think about edgier campaigning or edgier types of advertising that could gain momentum in a sort of viral sense?
Look, I think, how I think about it is we execute against our playbook. And our playbook, it's no secret. We talk about it all the time. We start it with sort of why do we exist? What does each one of our brands mean and represent to consumers? And then we execute against that playbook relentlessly. And ultimately, through that process, you do create campaigns, or what we call releases, that drive cultural relevance and connectivity. And in the case, for instance, of Gap, which is probably the most developed brand within our portfolio against that playbook, we're not just creating cultural conversations, we created a cultural takeover. Our Better in Denim campaign is by far the best in our history, but in the context of the consumer connection, it's the #1 search on TikTok. 8 billion views, 400 million, 20 million in the first 3 days. And we're just getting started. So again, we're not necessarily looking left and right. We're looking center and executing with conviction. I do think it's really great for the industry when there are multiple campaigns and the industry is sort of activated through various different points of creativity, and it drives industry interest, which helps all of us.
You talk about consumer demand and driving consumer demand. Just generally, how have you seen the back-to-school season and the shopping? We've heard from the likes of Walmart. We've heard from the likes of Macy's. It's been pretty good, pretty solid.
Yeah.
Do you see that being resilient going forward?
Yeah, we're off to a good start. We're very pleased with the progress, the connectivity that our merchandise and merchandising is having with consumers. We haven't seen any significant change in consumer behavior or sentiment. So we're very encouraged with the early start back to school and fall season. And I know as I look at the product that's coming and some of the other marketing and culturally relevant conversations that we're about to have, that we'll be keeping the heat.
Just 30 seconds. Which is your brand, not your favorite, because all of your babies are your favorites, but going forward that you expect to have the greatest momentum over the next 12 months?
Look, I think each brand is in a different stage of its reinvigoration process. Clearly, we're very proud of our flagship namesake brand, Gap. I think that is furthest along in the cultural conversation and certainly the metrics, 4% comp growth on top of 3% comp growth. Old Navy, #1 apparel specialty brand in the country, consistent deliverables and executing with excellence. We're most proud of Banana Republic, clearly. Posting 4% comp, a significant milestone in its progress. And as you know, we're working on Athleta, which is an important brand in the industry. So I can't pick one. They're all individually driving. And I think as you look ahead, we've got a really powerful portfolio of growth.
Richard Dickson, thank you so much for being with us. That was Richard Dickson, the Gap Inc. CEO. Dani, I'll send it back to you. Thank you so much.
Lisa, thank you so much for that excellent conversation. Again, how to navigate a trickier consumer environment. That was Richard Dickson of Gap Inc. and Bloomberg Surveillance co-anchor Lisa Abramowitz. Also want to mention that we are in the middle of Stephen Miran's hearing. He got a question from the chairman of the Senate Banking Committee asking about Fed independence. He said that it is of paramount importance and that he would act independently if confirmed, while recognizing that Trump chose him based on his judgment of policy, and again saying that the president nominated me because I have policy views that I suppose that he liked, but saying that he would act independently. We will listen in just a moment, but first I want to get back to one of our top stories when it comes to tech, because we have some fresh developments in the artificial intelligence race. Apple is planning to launch its own AI-powered web search tool next year. Meanwhile, DeepSeek is targeting the release of its own AI agent model by the end of next year. For more on this, we are joined by Bloomberg Tech co-host Ed Ludlow. Ed, let's start on the Apple news. Apple has lost a lot of talent when it comes to AI, has been largely behind. Are they prepared to have an AI search tool that would rival the likes of OpenAI and others?
Yeah, we have important detail from Bloomberg's Mark Gurman and his reporting. It's called World Knowledge Answers. And the idea is that Apple wants to have something integrated as part of Siri, its assistant, that gives you something not like Google search, but more akin to OpenAI and Perplexity, internet-wide summarized information based on a question or text prompt. That's what they're working on. And what we understand from sources is that Google's Gemini model is the underpinning of it. And at the same time, this has been the frustration, right? This was the stock story for Apple in the first half of this year. Show us more about what the future of Siri and your kind of software offering looks like. We understand, based on Bloomberg's reporting, that there is a Siri revamp coming in the spring, iOS 26.4, and that this World Knowledge Answers, including a broader Siri offering, that's when it will come. Stock's down 0.3%. But, you know, it is something that I suppose investors have been waiting on. Now we have more detail.
Ed, just quickly here, actually, we're going to wrap things up. Ed, thank you so much for joining. And, of course, you can watch more on this, Ed Ludlow in San Francisco, when the tech show starts in about 25 minutes' time. I do, though, quickly want to go back to Stephen Miran's hearing because Senator Warren, yet again, is asking a question on Fed independence. Let's just listen into this one.
Role. And since you describe how you'll be informed by your political biases, I think the American people have a right to understand just how independent you are or are not. So let's measure that a little bit. Dr. Miran, let's start with an easy question to show that you have some independence from the president. Easy yes or no. Did Donald Trump lose the 2020 presidential election?
Probably have to.
No, it's a yes or no.
Microphone on, please.
Hold on, microphone.
Come on, and the chair is going to be tough on time. I just need a yes or no. Did Donald Trump lose the 2020 presidential election?
Thank you, Senator Warren. Joe Biden was certified by Congress as the president of the United States.
Right. So did Donald Trump lose that election?
As I just said, Joe Biden was certified by
Donald Trump lose that election? Can you say the words Donald Trump lost that election? Are you independent enough to say that?
The Congress certified Joe Biden as president
All right,
of the United States.
So that was one. Let's try another. Let me ask you another question here. The Federal Reserve relies on accurate and unbiased data to make monetary policy, including data produced by the Bureau of Labor Statistics. President Trump recently fired the BLS commissioner, alleging that she, quote, faked the jobs numbers before the election to try and boost Kamala's chances of victory. Do you agree with President Trump that the BLS published fake numbers to manipulate the outcome of the 2024 presidential election?
Thank you for the question, Ranking Member Warren. Look, the data quality from the Bureau of Labor
Statistics. That's not the question about the data quality. Did, as President Trump said, the BLS publish fake numbers to manipulate the outcome of the 2024 presidential election? This is what President Trump said. Is he right? You're the head of the Council of Economic Advisors.
The Bureau of Labor Statistics data on various measures has deteriorated steadily in quality over time.
I understand that you may have questions about the data quality, but I want to remind you that when the data seemed to show that Donald Trump's jobs numbers were doing well, I didn't hear you say a single word about problems with data quality. The only time you started questioning data quality was when the numbers started showing that Trump's economy was headed in the wrong direction. So let me ask you the question for the third time. We want to understand your independence. Donald Trump stated that the BLS faked the job numbers before the election to try and boost Kamala's chances of victory. Do you agree with that, yes or no?
The Bureau of Labor Statistics did not take corrective action to improve the quality of steadily deteriorating data.
Do you agree with the statement that they faked numbers?
I believe that they were complacently allowing the data to continue.
Do you have any evidence that they faked numbers?
Well, as I said moments ago, the data have steadily deteriorated in quality, and I'm happy to give
in other
some
words,
examples
just
of how
two
that
straightforward questions about your independence, and you've blown both of them. So let's shift to the inflation caused by President's economic policies, which you've had a key role in designing. You've claimed, for example, that consumers thus far have not seen any material macroeconomic increase from tariffs at all. Your statement. The numbers do not back you up. Since January, cost of groceries is up, cost of utilities is up, cost of housing is up, cost of back-to-school shoes is up, cost of backpacks and baby strollers up. Dr. Miran, the data say that costs for basic necessities are going up. But it's not just the reported numbers. Fed Governor Waller, who President Trump appointed, private sector forecasters, small businesses, and families are all telling us that the costs are up. Do you think those families and data experts are lying?
Senator, thank you for the question. I believe your question is conflating relative price increases with inflation, which is an increase in the aggregate price level. There has been no detectable increase in the aggregate price level as a result of tariffs.
You know,
there have
Dr.
been relative
Miran,
price changes,
you
as
have
there
made
always are.
clear that you will do or say whatever Donald Trump wants you to do or say, and that may work in a political position, but it takes an axe to Fed independence and will make life far more expensive for American families. I apologize for going over.
Senator Elms.
Thank you, Mr. Chairman. Dr. Miran, first of all, I appreciated the opportunity to visit with you in my office.
That was Stephen Miran, President Trump's pick for Fed governor, speaking on Capitol Hill. Maybe what will be the spiciest exchange of that, speaking with Senator Elizabeth Warren, asking questions of independence of the BLS, whether Trump won the election, and going on to about inflation. Bloomberg's Michael McKee has been listening in as well and joins us for Capitol Hill. Mike, maybe that was the most difficult part of this hearing. What did you make of that interaction?
Well, Elizabeth Warren sacrificed him. I mean, it was a ritual sacrifice to the gods of honesty, in the sense that nobody from the Trump administration could ever admit that Donald Trump lost the 2020 election. And Miran refused to answer the question. And then she asked if the Bureau of Labor Statistics faked data to help the Kamala Harris campaign, and Miran refused to answer the question. So, yes, there are some open questions about whether or not he is going to be an independent voice, since he's giving Donald Trump answers to this committee. But does any Republican care? That's going to be the issue, whether any of the Republicans on the committee, perhaps Senator Thom Tillis of North Carolina, but the Republicans have a 2-vote advantage on the committee. So if they don't get somebody else on the committee to switch sides, then it doesn't matter what Mr. Miran says. It just matters that he gets one more vote than he needs to move on to the floor.
Fair enough. And look, we also, as we were talking about, he had those questions about the BLS and whether you fake the data. And he went on just to say that they've been complacent, that the data has been unreliable. Mike, to have more people at the Fed talk about unreliable data, how does this change things? And again, all of this comes ahead of getting non-farm payrolls tomorrow.
Well, to go back just a little bit to that situation, the BLS had been reporting that job growth had slowed and unemployment was rising ahead of the Fed's decision to cut 50 basis points, which is the stated reason why they did 50 instead of 25 in September. Now, Miran is trying to make that a case of BLS missing the numbers, but there's no evidence that's true. And I would just point you to Chris Waller's statements over the last week or so, in which he pointed out that the BLS response rates have gone down, but by the time they get to the third revision, they're the same as they ever were. So they're not inaccurate, they're just slow.
Okay, Mike, thank you very much for that. And again, we are getting more testimony from the pick for Fed Governor Stephen Miran, responding to a question from Senator Mike Rounds. Let's listen in to that.
Whether I really should be believing the things that I believe.
That would include allowing the president to lobby. Fair enough? Nothing wrong with the president lobbying.
The president is entitled to a view on appropriate monetary policy, as is everyone else with an interest in the subject, and I welcome everyone sharing their views.
Didn't, as part of your role as chairman of the Board of Economic Advisors, wasn't part of that to carry for the president the message that you believed was appropriate to improve the quality of life for Americans by improving the economy? And wouldn't it be reasonable that you would have a very similar point of view than the president did? Otherwise, why would he be working with you, and why would you be working with him on trying to formulate those views in the first place?
Thank you, Senator. Yes, as the Council of Economic Advisors is tasked by the Congress with advising the president on appropriate fiscal and regulatory policy to achieve full employment and stable prices and prosperity through the American economy. The president selects people based on his evaluation of their qualifications and their policies. And I assume that he nominated me to the previous position because he liked my policy views.
You were asked by the ranking member a number of questions in pretty fast order. I want to give you an opportunity. Anything in particular that you'd like to clarify or make more clear with regard to any of the comments? I'm just going to give you just a few seconds here before I move on, but anything in particular that you'd like to clarify or correct?
Thank you, Senator. Yeah, I mean, I do think that independence of the central bank is of critical importance, and that's why when I look back at recent behavior and see things like climate being worked into the Federal Reserve's policy agenda, it strikes me as politicization of elements of the Federal Reserve that ought not to be politicized. And if I am confirmed, I will forcefully push back on the Fed straying from its core mandates that were assigned to it by the Congress.
Thank you, sir. Mr. Pickerton, I want to just put this for the record. I want to thank you for coming to meet with me in my office in July. I think you are a very accomplished public servant, and I believe that you're very qualified for this position. I want to thank you for your willingness to work with me to get the PASS Act across the finish line, and I do look forward to working with you.
And that was Stephen Miran, President Trump's pick for Fed governor, speaking on Capitol Hill, this time responding to questions from Senator Mike Rounds. Again, questions about independence, which Stephen Miran says he will act independently, but get back to concentrating on the Fed's mandate. Bloomberg Washington correspondent Tyler Kendall is standing by, has also been listening in. Tyler, there have been a lot of questions geared towards Stephen Miran about Fed independence.
Right, exactly, Dani. And it was interesting to hear Senator Mike Rounds, their Republican from South Dakota, press him on it as well, because he's actually one of the 3 Republicans, I'd say, at least from the Washington perspective, that we've been watching closely when it comes to this hearing. The others include John Kennedy and also Tom Tillis, who I know Michael McKee had mentioned earlier in this program, because they've been those Republicans who have sort of taken perhaps a more staunch stance when it comes to defending the job that Fed Chair Jerome Powell has been doing. And to give you the view from the Capitol, this is really been our first glimpse at how the Senate Republicans are balancing that previous support for Fed independence with their support for President Trump. And Stephen Miran there in his answer sort of thread the same needle that we hear from a lot of lawmakers, which is that essentially they believe President Trump is entitled to his views when it comes to monetary policy, with Miran telling Senator Rounds that he thinks it's good for there to be different opinions aired when it comes to these decisions around monetary policy. Of course, though, Dani, as you well know, it's not really the senators that Stephen Miran needs to convince. At this point, he was confirmed earlier this year by a pretty wide margin. He would need to lose 4 Republican votes to sink that nomination. And at this point, that doesn't really appear likely.
It's a fair point, Tyler. And I think what you were getting at is that he needs to convince the market, not the senators. This is a White House that wants to push him through so he can be on the FOMC for that September 17th decision. Tyler, what does the road look like for it? How big of a possibility is it that we could have a Governor Miran by that point in time?
Well, Dani, it's looking increasingly likely, and I'll tell you that Democrats tell us privately they're conceding that at this point there's not enough procedural moves that they can make that would delay this vote from happening before that September 16th, 17th meeting. So at this point, it is appearing more likely, though I can say that I did speak to a few senior aides to Democratic leadership on the Banking Committee, and they're going to say that they're going to try to delay this as much as possible, and that's why you're actually hearing a lot of these Senate Democrats geared their questions towards Miran. If you look at this hearing holistically, there's a few other nominees there, but it is clear that they're going to try to ramp up the pressure as much as possible. But at this point, the Senate is actually working on an expedited timeline, and it looks like this is going to head to a full floor vote in the coming days.
Yeah, fair enough. We're hearing from the senior Democrat, Jack Reed, which you can see speaking there, talking about Trump's effort to strong-arm the Fed as deplorable, now talking about climate change. Tyler, just quickly, only a minute to go here, but we also had a Wall Street Journal story that the DOJ was opening a criminal investigation into Lisa Cook. How is that evolving, the drama between Lisa Cook and this White House that is trying to get her off the FOMC?
Right, so this isn't necessarily surprising, Dani, because we had heard from a top DOJ official last week that they intended to do this. And we know that the White House is continuing to ramp up its pressure campaign on Lisa Cook, as today actually marks the final day that we're waiting for the administration to file some new documents related to the court case that is playing out. Now, as you'll recall, last week, Lisa Cook had asked a judge to issue what's known as a temporary restraining order. That doesn't have to do with the broader case, but that would allow her to stay in her job while the broader questioning of her firing plays out in court, and we've yet to get a ruling on that. So that's what we're watching for here as this story continues to develop.
Tyler, thank you so much for that coverage. Bloomberg's Tyler Kendall. And as you can see, Stephen Miran is still speaking, responding to a question about climate change. You can watch that confirmation on your terminal Live Go, or you can follow on our blog at TLiveGo. Coming up on the show tomorrow, it is Jobs Friday. We will be speaking with Rick Ryder of BlackRock BlackRock and Julia Coronado of Macro Policy Perspective, plus SparkChange CEO Josh Aviv on EV charging. All of that to come as Stephen Miran continues his confirmation hearing. This is Bloomberg Open Interest.
Under the law were inappropriate, and you recommended Congress remove those